Not sure if you heard what Steve just pointed out there, and the hope is really as far as economic and market disruption, we don't get to that point. What is the assumption you are making here?
So, of course, I think in terms of the military conflict, I would understand that both the parties are aware that stakes are very high. So what is happening right now is I think they are testing the preparedness and the response levels of each other. But my bigger concern would, of course, be on the strategic side of things, whereas, thinkings like if we could see a further leg up in U.S.-China trade relations or trade tensions, rather, and as well as, how important this chip supply and electronic supply from Taiwan is for the whole of the world. And if that could be used as one of the tools in terms of, getting a response from both the sides.
What sectors do you think are most at risk if these U.S.-China tensions boil over?
So like I said, in terms of Taiwan's importance to the semiconductor space and the electronics space, and having learned from what Russia has done in terms of choking the world of commodities and energy specifically, but also food grains, I think that could be one of the strategic responses that remain very important for us to watch.
So, Charu, the thing is, regionally speaking, how much is the dollar's strength, which persists, although perhaps we've seen a bit of flattening of it, how much is that do you really take into account of when you're making decisions?
I think it will be really important to understand what's at stake here. And of course, looking at what, Taiwan is doing, or, in fact, involving Japan into it as well is kind of a very gray area, and response will need to be monitored as well.
Ultimately, is the market here at the moment mispricing what's going on with the Fed's intentions?
I think after Powell kind of, stepped back from giving any forward guidance, the markets are pretty confused at the moment, and they've started to price in rate cuts for next year. But we have seen a lot of Fed speakers come in after that with a more hawkish rhetoric, kind of hinting at that inflation still remains a bigger problem, even though there has been demand destruction and there will be probably some economic slowdown to come in the U.S. But, the market is still, I think, way behind on that. And my sense is that with this jobs report and the inflation number due next week, we are likely to see these market expectations for the terminal Fed rate getting revised higher.
Okay, so does that mean that when it comes to treasuries, we have further adjustment where yields can actually stay in the short end above 3% now after this report?
In my sense, I think that certainly is a possibility. The yield curve, at least on the short end yields, they are likely to get a bump up higher once markets reprice these Fed expectations. They understand that the Fed is still in an inflation fighting mode and will likely remain aggressive with its rate hikes. We are likely to see some more rate hikes next year. That should bring the 2-year yields above 3% in the near term, I guess.